Good morning, it's Jeffrey Cohen. It's Tuesday, November 29th. It's 8:10 a.m. I know I said I'd be on a little bit later, but I got so many meetings today. It's great. We've got a post-quantum cryptography session with NIST, and we have another consortium meeting today, which is great. And we made a lot of progress last night. We're wrapping up our brochure. I know I'm getting calls from folks to wrap this up and get it submitted. And I just want to talk about the markets. We're going to talk about the markets. We're going to talk about our runs and what the market said, what the runs say. So yesterday, we were spot on. I'm so proud of our work. We talked about yesterday being an aggressive risk-off day, being a really bad day to have risk in your stocks. And then we followed through the day, and the markets had a really bad day. And so I felt really proud of the work of our model and the work of our people and what we're doing. And so, great. Also, on a personal note, our portfolio went up a little, so that even felt good. It was nice. And then lastly, on a real personal note, my son, Lucas, we just went with him, and he got his first truck. A Ford 4x4 F-150 that he can use to drive to work. He works on a military base. He's a civilian contractor. I'm so proud of him. And he's working hard. Now he's got a truck. Now his mama doesn't have to drive him. That's terrific news. Of course, mom and dad helped a lot, but he's a good kid. And so he should have a truck, and he does. So that's nice. I mean, it's used. It's got a lot of miles on it, but it's a beautiful truck. God, to be 18 again is so awesome. So, let's get back to it. Where are we? Markets. Who knows today? It looks like China's clamping down on its protesters. So, I don't know what's going on with that. But if we look at the futures right now, it looks like S&P's flat. Dow slightly down. NASDAQ and Russell are up a little, which is great. Looks like bonds. So the actual bond futures, so the 30 years are down a little. The 10 years down just a tiny, tiny bit. The 5 years down a tiny bit. The 2 years actually up. Commodities are all up. So maybe the recession trade that said we were all going to be, in big trouble is behind us. It's hard to know. Let's look at the world indices. How did China? I'd read that China did okay. So Hang Seng up 5%. Mainland China up 2.5% means the Communist Party of China clamping down on its citizens. I mean, at Tiananmen Square, they killed 10,000 during these protests. Maybe they kill another 10,000. Good for the stock market, right? People like it. China's stable, right? Personally, I'd love freedom and democracy for China. You have it. Chicago Quantum supports freedom and democracy for China. However, it's probably not in the U.S.'s best interest that China goes democracy, because it would actually make them stronger, make their economy grow faster, make their people happier. Oh my gosh, can you imagine a China without communism, without dictatorship, without bloody clampdowns? It'd be an unstoppable force in the world. We would have to compete for being number one. I'm okay with the competition, by the way. I'd love to see it, but I don't think we're going to see it. So, South Korea's up, New Zealand's up. Jakarta's down a little, but it doesn't move that much. Australia's up, so Asia's fine. Europe is pretty much unmoved. Europe is unmoved by everything. China's up way high. If we look at the futures, you see some slight green on the U.S. equities. What I look for, what I like to see is the VIX, right? So the VIX is down. Although, let's be honest, you divide by 19.2, and that's your 1% kind of implied volatility. And so you're like 1.1, 1.2, 1.2% drop is the cost of insurance. So it's not that bad. But you see all the core commodities. Energy's up. Food's down. Maybe food's going to be a little cheaper. Silver keeps dancing around that $21 mark. It's really 21, 22. And the U.S. dollar is a little bit weaker again today, which weaker dollar, stronger stocks. Kind of makes sense. So I'm not sure I see much with this market. Yesterday was just a terrible, tried to rally at the very end, but it was blood red. When we look at the 1 week performance, S&P 500 actually does not look that bad. It's so fascinating because you would think the S&P, with the model calling for a bad move forward, is there's no reason to believe the market should be de-risked, but in fact, our model says de-risk it. And so let's do that. We're going to take a quick look. Well, we got Cohen. You can see the market was pretty much down all day with a slight recovery in the last half hour. You can see yesterday, discretionary, consumer staples were the best performers. Real estate, energy, materials, tech were the worst performers. So interest rates must have risen, even though I didn't really see it in the numbers. So where are we with our model? What did our model say? And then we're going to talk about our brochure and our services. So I'm sure most of you will tune out for brochure and services, but I think it's fascinating, right? When you build a hedge fund, actually we're going to be doing separately managed accounts where your money is kept with your custodian, where you have an account. So it's not like FTX or Crypto Fee or any of those guys, or Binance, where you give us your money, you keep your money, you have ownership of your money is sitting in an SPIC insured account. You give us trading authorization, you pay us a monthly fee, we trade the model for you on your account. By the way, you don't like how we're trading, you don't like the work we're doing, cancel at any time, boom, take trading authorization away. There's no risk. But if you like what we're doing, and you like how our model's doing, you pay a fee. Hopefully, you achieve your financial objectives, right? So this is our down run. So again, the expected market return to risk is 4.8%, which is very, very low. Okay, it's very low. 805 stocks past data validation. That's less than before. So I think yesterday was a very low liquidity day, and it hurt. It hurt a lot of stocks. They just didn't trade enough. I think you're going to lose stocks because of this in the model. You have to trade every day to be in our model. Like at least 20,000 shares a day is nothing. So variance is 8.0 times 10 to the negative 4. It's about the same where it was. And you can see Alekos and then other therapeutic firms are actually the worst performing stocks, the worst risk return trade-offs. And then you get some interesting ones like the F45 Training Holdings, Telos, Bed Bath & Beyond, Desktop Metal. These are the dogs that you do not want to be in if you want to be managing risk return. Most of those you see are actual therapeutics or biotechnology companies. Board Drilling, right, looks tremendously successful this morning in pre-market. I want to say it was up 6%, but just goes up and down. Black Sky Technology, Tupperware, Snap, Everbridge. These are Carvana, AMC. These are stocks that you either avoid or short according to our model. And there's other stuff in there. You get the point. The S&P 500 variance at 2.3 is about the same. So we're not seeing any change. I'm going to revert changes, close it. So let's take a look at the S&P 500 run and see what it tells us. So on the down run, it says largely biotech, but there's others. Be selective, right? Your meme stocks, your dog stocks. Stay away from them or short them. It's cool. Same, of course, same expected market return. S&P is at the 2.3 times 10 to the negative 4 variance. Here you have 1,711 stocks that passed data validation and a variance of 2.6 times 10 to the negative 4, same as yesterday. It's roughly 1.13 times more variance than just holding the S&P 500. What's interesting is if you can only hold one stock, the S&P 500 ETF is the best stock to hold. It actually performs better than the risk of the entire market. And then you've got your 1 to 3 year Treasury bond ETF. So you can almost imagine a fantasy, or you're a retail investor and you just put your money in the S&P 500 and some short-term bond funds. Call it a day while the market looks the way it looks today. It's not quite that easy, but you can protect a lot of your returns that way. So there's leptokurtic stocks, there's skew stocks, positive skew, negative skew stocks. Some people like to trade that way. Leptokurtic and low variance, platykurtic and high variance. Coinbase, FLNC, you're going to find those options to be very, very expensive. And then our best portfolio has 20 stocks at a 57 tick advantage versus a 3 tick advantage. So it's 20 times the advantage of just holding the S&P 500. And you get your mainstays. It's starting to look a little bit more back to normal. Intuit, European Wax Center, I like to call them earwax, Broadcom, Rocket, NVIDIA, starting to look more normal again. Thank you. I was getting worried. So today, risk a little bit more on, okay? It's a little more okay. It's saying, you know what, it's okay. Maybe get back into some of those rough names. So I'm figuring maybe by tomorrow we'll be really back in, but that's good. That means risk is a little more on than it is off, and we're going to shut that one down. Now, one last thing to show you is I want to show you our brochure and some of our key services, and if you're out there, maybe give a comment. Tell me what you think, okay? And then, by the way, I've got actually a really big conference call that's coming up in about an hour. So, and I know the market's opening. We've got some big meetings today. Two actual conflicting meetings. We're going to be bouncing between them. So, hey, Jeff, what do you do? What does Chicago Quantum do? How do you make money? And then maybe we want to be a client. That'd be great. So we have separately managed accounts. I've got to get this brochure in Charles Schwab so we can get that all set up. But we're going to be using, again, a third-party custodian and brokerage. So separately managed accounts are an ongoing service, performance-based fees. It's a financial service. Quantitative analysis of U.S. stocks up and down. You just saw me show you a little bit of it. By the way, there's a spreadsheet that you get from doing that. I'm going to show you what that spreadsheet looks like. So you get this if you buy our services. This is the up run, so I usually make it green. And then I like to freeze the header. There's actually there it is. Freeze the foot, freeze the header, freeze everything. Columns, you name it. So what you get is you get all those 1,700 stocks. And we've added a couple of ETFs in there as stalking horses. I think it's important. You get your score, your individualized Chicago Quantum net score for every single stock. You get your percentage expected return. You get your volume. You get your closing price versus the average for the year. You get your variance. And those variances are normalized so they're comparable. You get your average dividend yield actually paid compared to the actual price over the past year. You get your beta versus the S&P 500. You get your market cap. If you see all nines, it means there's no relevant data. So as an example, for an ETF, there's no market cap. You get your cash flow from operations trailing 12 months. You get your net, long-term debt, current. You get your net income, common equity, and then your AOCI, which is your accumulated other comprehensive income. So for every one of these stocks, you can start to play around and look around and do some valuation analysis, some basics. It's really helpful. I find this really helpful if I'm looking at an industry sector. So you get that every time you buy a run, and you also obviously get the run. So that's cool. So, all right, fine. So you get that. You could buy it up run or down run. Up run, profitable companies, good. Down run, unprofitable companies, ungood. Financial planning services. We'll spend about a week with you. It's about 20 hours worth of work. And we'll build a financial plan or an investment plan for you based on your needs, based on your data. And so it's a fixed fee. We have computer programming services. So we have a platform that has solvers, uses Python. We do a lot of coding. We use Intrinio for data sources. We'll code for you. We'll give you a model, or we'll code for you, we'll produce a model for you, and we'll run it for you. That's pretty cool. I'd love to have that. Consulting services. So we'll provide either in the information technology space or the financial space. And we'll do core consulting services, or we'll do management consulting services specifically in the technology space. And if we're too busy, folks on the team, I've got a full network of folks that'll come in that are similarly qualified. So how do we bill for those services? So separately managed accounts are 2% a year, asset-based fee. So if you got $1 million, it's going to be 20 grand over the year. We have a minimum of $1,000 a month. That comes out to $500,000 invested over the month. So if you need time to work your way up, we just ask for you to pay the $1,000 a month because we have expenses and costs to set it up and manage and get you statements and things like that. And then it's performance-based. It's 20% on gains above 1% a month. So basically your first 12% profit a year is free. And then we take 20% of the rest. We have a 1 month high water mark. So if you buy an analysis, a quant analysis, it's $750 a run. Financial planning services, 20 hours is $2,500. Now the reason that's so inexpensive, first off, that's basically kind of the going rate of these types of services, but also, we hope afterwards you may become a client, right? Oh, that's great. Computer programming services, consulting services, management consulting services, we're billing them all at $250 an hour, or you can pre-buy 40 hours for $7,500. So what do you get for the services? And so if you buy an up run, whether it's the space on the S&P 500 or the QQQ or the down run, you get all our data validation parameters. And by the way, you could potentially customize your service. If you wanted to suggest a different parameter, we can work across the clients and see if everyone agrees. Key filters, optimized portfolio, yes, you get those. You get market return, stock variance, stock by CQNS score, stock by volume, all the stuff you get. You get your leptokurtic and platykurtic stocks. You get highly skewed stocks. You get negative beta stocks, high beta, low beta. You get stocks by dividend paid. Stock expected return, stock price spikes, stock volume spikes, stock splits. You also get for the up runs, and we could code this into the down run. We haven't had a client ask for it yet. But capitalization, like we showed you, cash flow from operations, long-term debt, net income, common equity, AOCI. That's a ton of data to wake up to before the market opens and to then be able to make your trading strategy. We love it. So that's what you get. And then we have a brochure that we're trying to finalize. We're down to the last sections, and you'll be able to buy our services. So how are we doing? So I think the market's going to open flat. And it's hard to say. The market's saying, our model says, risk should not be quite as off as it was yesterday. With no change in the model, just a change in how we run it, the model's a little more comfortable with risk today. And so I guess good luck is in order, right? Good luck to all out there. And if we look at the futures, right, we're not really green. We're flat. VIX is down, but we're flat today. And if we look at the futures right now, yeah, we're flat. So good luck today. Model says it's okay. It's okay to put some risk on, and that's where we're at. By the way, if you like the video, hit the subscribe button. Really helps us. Drop a comment. Say you like it. Maybe share the link. We're not paid to make the videos. We do it really just to share with you what we're working on, and try to potentially, show what we're doing to people. Here's the table of contents of our brochure. By the way, it'll be on our website when we're done, and we're happy to give it to you for free. You learn a ton about how we set up our business, and thanks so much. You take care. Markets open. Bye-bye.